Good morning, and thank you for this opportunity to talk to you about the U.S. critical minerals dynamics and the current policy aspirations that the U.S. has, and some of the market realities that it faces, and how that may potentially lead to some market warping on a global scale. I am approaching this conversation not in the details of the policies, but more on a macro level and looking at the macro dynamics relative to the minerals market and the minerals industry. So some may ask, why now for the United States? We sort of had walked away from a big focus on minerals for quite a while at the end of the Cold War. But, at the most fundamental level, economic growth requires more minerals. And I think the experiences in COVID-19 helped everyone recognize that there was fragility to the supply chains, and we needed to get focused on that in order to sustain growth. And interestingly, this is absolutely a bipartisan issue. Maybe the lead motivation, whether Democrat or Republican, may be different, but fundamentally, both parties are definitely in support of strengthening our mineral supply chains. Some of this is, related to the geopolitical dependence on China relative to minerals, whether it's up in the refining level or even in some cases for the original sourcing. And in addition, we have the whole political economic competition with China. The U.S. usually thrives by having some kind of a competitor that it likes to focus on. And I'd say that is now China. So this is an interesting dynamic to have. And on top of it, the Ukraine war dynamics, as well as some of the spreading trade conflicts, they've destabilized some of the supply chains even further, and has really brought this up as a policy level and a strategic level issue for the U.S. So in particular, I want to explore this through the lens of the use of scenarios, in particular the scenarios that the International Raw Material Observatory developed last year. I think these are really great ways to examine the political, economic, social, and technological dynamics. And in this case, these were set for where raw materials in 2050 might be. And the scenarios themselves, the individual scenarios, represent different end members, and where the reality is sits within. So this entire conversation is being crafted around what we learned within the scenario development process and some of the thinking about the interconnections that occur. And I find the scenario process absolutely a wonderful way to harness collective wisdom. In our case, for the intra scenarios, it used the pestle framework, pulling in all of these externalities into the conversation on the raw materials sector. And we were able to then leverage experts from the European Union and the United States to really get us some understanding about all the different cause-effect relationships within different actions within the raw materials system. And this was launched basically with sort of 20 main factors, and then the experts helped build out a lot of the texture, what specific actions, what specific outcomes would be expected, as we move through towards 2050. And what you end up with is a very large collection of cause effects. And we ended up sitting down and having to do a cross-impact balance analysis. So imagine a spreadsheet of 4,000 by 4,000 actions, and then mapping them to how it responded to each other, whether there was any response, cause effect. If it was negative, if it was positive, was it strong, was it weak? And this helped guide our process to understand, to separate out the different scenarios and what they actually mean. So here's an example of the various raw material factors, sort of top level factors that we presented to the experts to build out the scenarios, and then sort of underneath. So think of it being a sort of scaffolded down. There's more and more detail that those experts then provided in the texture. As far as the interrelationships of whether social or technological advances, economic issues, things like that, and how they would interact with each other. So I'm just going to step through each of these scenarios. I call it the most optimistic scenario had was the Great Transition, And really, it was focused around globally we had common goals, and that we had general cooperation across the world economically, and that one of the outcomes of this is that we saw stable policies, stable pricing for minerals, and that technological advancements really was what was driving profit. In other words, efficiencies that were being provided. And because stable mineral supply chain it was underpinning this economic success, mining sort of status in society, it's viewed more as a part of the solution. The other, sort of more positive scenario, we call it the advancement wave. The world was broken into trade blocks, but in general, those individual trade blocks had common outcomes that they were looking for. They were just competing with each other towards that. Now, any of those kinds of divisions were leading, to limitations and created some instability in pricing, definitely some challenges in labor, and perhaps some challenges in finding material alternatives, as you had perhaps some friction on the trade front. In general, mining was still viewed as a positive player within this interblock competition. Certainly not a major negative, but more towards a neutral stance. So we start moving to maybe what we might view as a more negative posture. We call this divided dominions. This is really where we have real politic going on. You have global trade blocks that are really driven by strong powers. You have rising nationalism, and that the policies really are individually built into those individual blocks. And one of the things is you start to build walls around the supply chains. And it really starts to inhibit, the overall growth is much more independent to each of these blocks. Clearly, when you start disrupting this sort of global free trade, you start introducing instability in the pricing. And because now that instability is escalated, it's starting to have some negative impacts on the economic performance. Mining is now starting to be viewed as part of the problem. And then perhaps maybe one of the most negative end member view was the downward spiral, where alliances were very much just transactional, very much ad hoc, focused on short-term nationalistic interests and policies. And because of the political instability, not knowing who your friends were, not knowing what your long-term partners are in something like mining, which is a long-term capital process, it really started to break down the supply chains, and would argue that we would actually see economic regression in place, in the sense that some advancements in economic policies that we've seen over the last number of decades would start to be walked back. And this instability leads to further pricing instability. And with that uncertainty, I think one could expect actually regression in the mining practices as capital becomes more difficult, cash flow becomes more difficult, the industry has to respond to the realities of what's on the ground. Obviously, this is a scenario where mining would be seen as a major problem because it is sort of an amplifier of the instability in the economic situation. So, one can say that this year we've had policy shocks, and to be honest with you, I think with this administration, policy shocks are actually intentional, meant to shake up the system. Interestingly, there's a new proposed critical minerals list for the United States, expanded, to well over 50 critical minerals. And we're quickly approaching pretty much all major commodity minerals. It's not all full coverage, but we're getting to a very substantial component. And that's not necessarily a bad thing. It's a recognition of the complexity of the material supply chains and how industry works and the interdependencies that we see this kind of expansion. So, that's a very much a real politic, and that is, a bit of a change compared to, say, the EU's critical minerals list. We do see the Defense Department, in the big beautiful bill. You start adding up all the different parts. It looks like it has somewhere around $7 billion of discretionary funds related to investments it can put into the mineral sector. We've seen some of those in place. the investments in MP metals, to help with heavy rare earth processing, seeing some direct investments, acquisitions of actual mines and mining companies. And that does bring up the question: is this a sort of a semi-nationalization of corporations? These government direct investments in mines and processing is actually leading to, and this isn't necessarily a value judgment, is leading to national policy being expressed through the actions of the companies. It's a fair place, and I wouldn't say that that's historically unheard of, certainly in the United States, but it is a change from before. And we do have a bit of an isolationism overprint applied to pretty much all policy actions right now. It is an America First view. And so a lot of this is about focusing on domestic production, domestic reliance, and building up those capacities. But it's building up our capacities, from a production and supply chain standpoint that's starting from a pretty low point because of previous economic position. Interestingly, some of the budget rescissions that have been implemented, they really did. They've impacted the core infrastructure, education, and labor availability. And those are things, as we did those scenarios, are these really critical underpinnings that we quickly see responses by the mineral sector into whether or not new prospects can be developed, whether or not production can continue, whether or not they shift to other commodities. And so we have these market realities. And I think one of the challenges is that in the United States we have a whole bunch of folks, I'd say, in the middle level policy that really do know the mineral sector. They understand the time dynamics, the capital dynamics, the labor challenges, the regulatory challenges that are required. But at the same rate, there is a policy. There's this very high level policy space saying minerals is an imperative. I don't necessarily disagree, but there's a disconnect in understanding all those other developmental dynamics. So until those policy implementation processes sort of percolate down into the system, there's a pretty good disconnect in the market. And so, understanding that mine development doesn't operate on a political cycle, but it does mean that we are seeing the United States make very direct investments. One might argue, in an American football standpoint, it's like a Vince Lombardi move. Pay a lot now to win today, let tomorrow take care of itself. Hard to judge what that really means and whether the U.S. industry can sort of ramp up in the shadow of that. The other thing too that we find is that there are modest returns in mining. I think the last thing I saw was about 4% is the average return on investments in the mineral sector. And we're right at that point in interest rates, certainly on from the Federal Reserve. And if you look at Treasury bills, and if we have continued pressure on funding the debt, those interest rates will go up. And so if we get into positions where do I make more money by leaving the minerals in the ground? The capital markets are going to make their own decisions. And so this is another reason why I think we're seeing more strategic, proactive activity by the federal government. And look, we do have a workforce crisis. We have very few geoscientists, miners, metallurgists, trade workers, all of the folks that are needed to successfully ramp up the entire mineral supply chain in the United States. These individuals exist, but they're spread across a lot of industries. There's a lot of other competing industries. We don't have the big aggregate to meet all the needs within our the entire United States economy. So and it takes time to develop that workforce, and that's another one of these disconnects perhaps between the political cycle and the actual raw material development cycle. So it's a question. I mean, is the United States fundamentally starting to become a state player? Wouldn't be the first time, because there is this policy imperative for mineral access. And that's been developing, as it says, bipartisan. But we have seen a walk away from the policies that really date back all the way to World War II I'll call it the friends and families approach to minerals, where there's a strategic advantage for the United States to keep its own minerals in the ground and to work with reliable allies and partners in the economic development and the mineral development in those countries to help provide some of those sources. And obviously, there's the question when we don't have the actual minerals in the United States, these are the only players. So that's a bit more of a complicated space. And what is interesting is because we're seeing these direct investments like the DoD, for instance, you now are having taxpayer capital being used to go after minerals. This is supplementing perhaps within the regular investment markets and can accelerate process. And then there is the unrolling of regulations, by this administration, and calls for potentially things like being a bit more liberal on how they would approach, say, deep sea mining, things like that. These are big changes if you suddenly have the United States going in these directions. And so if I take a step back, looking at what we learned in building those scenarios, what these behaviors look like from the outside. And so it's almost like the US is acting like a national oil company, but in the mineral space, in the sense that the private sector is a tool for the policy implementation of the country and less of an independent player. So much more direct policy action there. And let's face it, that's sort of what a lot of China's model is. So is this the U.S. sort of converging on how China's approach raw materials? It's an interesting question. And I think this could, for the European Union, represent a disadvantage because the EU is still focused on those cooperative strategies. I think that's a wonderful thing. But now you're getting more and more sharp elbows in the market. And so that is something to recognize. So it's interesting. So using the balance analysis and looking at the scenarios, I tried to sit through and say, okay, since the start of this administration, how is the U.S. position in the raw material sector? Where is it looking at? And I would argue that at inauguration, the U.S. was somewhere right on the boundary of the advancement wave and the Great Transition. There was investments for EV. There was a definite recognition that we have a global competition for minerals, but we're all going for a lot of the same fundamental outcomes. Come the election, what's interesting, when you look at sort of the sequence of some of the budgetary rescissions and policy changes, particularly impacting minerals, even though I think like 4 of the first 6 executive orders were mineral focused, some of the underpinning pullback on, say, the infrastructure bill actions and things like that actually sort of temporarily shifted, I would argue, the U.S. mineral sector a bit more into the Great Transition, into some of that electrification, but farther and farther away from sort of the bigger common goals. And sort of it's a reshaping process. And then I think what we saw is as we headed in, we started having the trade uncertainty, and we definitely saw relationships change between the United States and a lot of its traditional allies and other countries. By June 2025, we were really starting to head into a divided dominion space in which that there were distinctly competing blocks, economic blocks, the U.S. in a lot of ways being sort of its own block in some of its behaviors, but not necessarily with a common cause. I think it is a concern as of someone from the United States that in September 2025 we seem to have been shifting. We shifted hard to the right here, more towards the downward spiral space, in the sense that suddenly we have this summit between China, Russia, and India. This creates a very interesting potential economic block challenge for the United States, and could be leading to some serious fracturing. And isolation for the U.S. And that gives us this concern, are we slipping into some deeper space for the U.S. Raw material sector into a downward spiral? Or to be honest with you, and this is the beauty of the scenarios, you can then be playing with the different parameters and see how we can move into different areas. So that could potentially move, closer to advancement wave. We could just move and settle back more in the divided dominions. Hard to judge. But it will certainly be somewhere in the bottom, these bottom right 3 quadrants. So what are some of the implications and opportunities? From the United States perspective, this current disconnect, and hopefully we'll see the mid-level policy folks really start be able to apply their trade, and get things moving in a stable and very constructive way. But there is a serious risk of policy overreach. And that could lead to systemic failure if basically it's the investments all put up front to solve today's problem without looking at these long-term challenges. I do think the European Union does need to think about how it's going to adapt and counter perhaps a more state capitalist U.S. posture. As I said, sharp elbows, not necessarily to be a competitor, but perhaps has to recognize that not everything will be a strict collaboration. In the industry space, I think it's inevitable. We're going to see increasing complexity in product delivery. I think the capital markets are going to be very complex as we see some of the interest rate dynamics, debt management, and things like that relative to what these returns on the minerals, particularly if we don't see the economy start accelerating. You probably are looking at multiple state competitors. And I will say this, though. History, certainly in the commodity sector, says well-played chaos can be quite profitable. There will be winners in this current turmoil. There is no two ways about that. It is pretty hard to see who that's going to be, but there will be individuals that, in essence, not necessarily playing with our scenarios directly, but will have played through those reaction components and put themselves in a better and more profitable space. So it brings up the questions, how do we sort of see through the fog? Because it is very unclear where the next steps, where things are actually heading right now, I think, on a global basis. And I think scenarios are great tools, not just Intras. A number of other think tanks and other groups have developed them with their own strengths as well. But I do think these provide great opportunities to show how we can align policy and reality, because they are not being, I'll say, forced by political will. And on the other side, they do help identify and flesh out the pathways of risk if we ignore the challenges of the time frames, the economics and finance issues, and the people issues. And so the other side is, I think the scenarios can help identify what the next options are, in particular in our case related to U.S. mineral policy. I think if we see the expertise within the U.S. government and industries start to be able to actually apply their expertise, we will see the movement into stronger positions for the United States within our scenario map. But obviously, it also fleshes out, if we don't succeed in that, what some of the implications are. I think the other side is the U.S. is moving very, very quickly. It's moving at political speed. Never thought I'd say that was fast, but compared to the minerals development sector, it is fast. And because of that, that actually risks warping markets more than securing them, because if the U.S. becomes much more of a state-like player, that's a very forward and large capital player on a global market. And I think other groups like the European Union are going to have to figure out exactly how they manage with that dynamic. And at the end of the day, it's an increasingly unstable world for a million different reasons, and we have to prepare for multiple futures. I don't think we can just say we have this goal and that's all we're preparing for. I think we can say this is our goal, but we need to be ready for that entire spectrum of what's coming down the line. So thank you. I appreciate your time.